Hi, Louis Giannis. Wanted to come to you today to talk a little bit about the differences between advisors that are managing money themselves versus advisors that are actually using outsourced managers. So there's this huge trend in the advisory business, in the money management business, where most financial planners or financial advisors, what they're doing is they're using what's called model managers. And model managers basically are investment firms like us who have expertise in managing assets, and they basically sell that service to financial planners who may not necessarily have investment management expertise, but maybe they are more involved with planning. And this is a huge trend in the industry. In fact, of course, Wall Street wants to package up things and do more and more of this. So this trend, I believe, in many cases, is actually hurting clients. And let me explain this. When I look at the advantages and disadvantages to actually using an outside model manager, if you will, and managing in-house, I see huge advantages to doing it the way we do it, which is managing our own investment strategies. First of all, the big advantage is that has a lot to do with the fact that my experience set is in managing money. I'm a chartered financial analyst, chartered market technician. I've been more involved with the direct management of assets than most planners have been. Most planners have spent most of their career learning about sales and about influence and planning itself, like how to do a financial plan. And a lot of those services are desperately needed as well. But if you actually look at it, you just go down the list of what the advantages and disadvantages are. And I actually wrote them down because I found them to be so compellingly interesting. So let me first talk about from a financial planner's point of view. So when you go and you hire a financial planner, these are the things that they're thinking about when they're delivering their service to you. Many of them are thinking that, look, I don't have that much experience in managing money, so I'm just going to use other people's techniques and experience to do it, and then I'm going to pay them to do that, and then I'm going to charge my fee. So what happens is, for many clients, is that there's really fees upon fees when that happens, because they're paying the model manager's fees, and then they're also paying the advisor's fees. And rarely do the advisors lower their fee to compensate for the increases in fees of the model managers. To make matters worse, many of these model managers actually invest in packaged products like mutual funds and ETFs, exchange traded funds. So not only is there fees from the model manager, but there's also fees from the funds that they invest in. And sometimes there's transaction costs. That's less and less now, but sometimes there is. And then there's also the fee from the planner. So you just start stacking fees upon fees. This doesn't make sense, but this is what financial advisors, I would say the vast majority of financial advisors are doing for people. This is not cool in my book. The other thing that a lot of financial planners are thinking about is hey, look, I'm going to have less time to spend time with my clients if I'm doing all this money management activities. So I totally get that. Clients need attention. And I think from our perspective, using technology is really helpful, because now with technology, we're able to scale routine rebalancing techniques to be very, very efficient. So gives you still more time to be with clients. But this is what financial advisors are thinking. So that's why they're doing this. The other thing is, for most financial planners, it's difficult for them to even come up with the concept of how do I create a high-performing model? How do I create a strategy that is going to do well? Just again, that's just lack of experience. Not that they're not smart or they just maybe have not worked in that field. So the other issue is limited bandwidth. So there's a lot of advanced strategies that perhaps a financial advisor would not have access to, because they're not. So when they add this all up, they go, okay, look, it's more expensive. My expertise is somewhere else. I can just outsource this and still charge my fee. That's what's being delivered. So I want to compare and contrast to that how we do business, because there is a difference. The advantage to managing your own portfolio strategies is you can tailor the strategy to the client more. Since we own the securities directly, it can be very tailored, highly customizable, and we don't lose control over the decision making. Especially like, for example, this last drop that we had control over those assets so that we could actually manage risk for clients. rather than sitting and watching some other manager lose a bunch of money. Not cool. We don't really want to do that. The other thing is our value proposition is our asset management. We have expertise in that. We've proven ourselves through many multiple cycles. So that's part of the reason why we still manage money for people. The other thing is you lose clarity and insight into what you own. So when we're sitting down and talking to a client, we're not saying, well, I'm not quite sure what that manager's doing. No, we're saying, okay, we own this particular stock and these bonds for this reason. Here's the strategy. Here's why we own it, and here's why we sold it. So it gives you much more clarity as to what you own. And the other thing is many of these outside portfolio managers, and we've done studies of this, and I've done studies of this, where I've looked at these model managers and I looked at their performance record, and the vast majority of them are so highly correlated to just a blended benchmark portfolio that I could build for nothing in fee, that I have a hard time justifying their fees. So I would rather just have a client be in a balanced strategic horizon portfolios. We have portfolios that get that accomplished that are very low cost index, blended. Most of those managers are charging higher fees and they're not even performing significantly different than those types of portfolios. So I say, if we're going to invest like that and you're not going to try to do something that's going to give you a better return risk, then don't pay those extra fees. So many of those outside managers are modern portfolio based, and there's lots of reasons why they do this, but we don't agree necessarily with modern portfolio theory. In fact, Andrew Lo, a very famous, I guess you could use the word famous. He's an academic gentleman at MIT, very well respected, has basically debunked modern portfolio theory. So this is, we know that it not to be true, yet assets are being managed this way. So anyhow, so the cost of outsourcing to other managers is higher. So we want to avoid those costs. We're owning those securities directly. For most accounts, we don't pay any transaction cost anyhow now. We just have the bid-ask spread, and we manage that in how we trade. So, and now with technology, we're able to have many of the routine rebalancing being done in a tax-efficient way. So this is a much better value proposition for our clients, we feel. The other reason why we manage the money directly for clients rather than doing outsourcing like planners do, is because you lose flexibility on how it's managed. You lose flexibility of the return risk. I mentioned this last market decline. This becomes critical whenever you have market declines, and we've been through multiple of these big declines, and we know what we need to do during those times. We need to manage risk. We need to look at what regroup and see what's happening in the marketplace. So a lot of times when you go through these model managers, you're just sitting there and you're just losing money. And we want to be more proactive with our clients. And we feel like we have our clients' best interest in mind when we're managing the model portfolios ourselves. Are we perfect? No, but we have disciplined strategies. We like to use evidence-based approaches using quantitative analysis in developing these portfolios. And we also put safeguards and guardrails into portfolio strategies to manage risk in terms of diversification. So that's something I just wanted to point out, because I think there's a lot of confusion out there as to what advisors are doing for people. Most financial planners are hiring outside managers, and they're doing things that way, and then the fee structures could have more layers of fees because you're using more packaged products. We, on the other hand, we tailor have highly customized tailor portfolios. We don't lose control of the decision making for you. We have absolute clarity and insight as to what we own, and we have strategies that are not purely based on modern portfolio theory. They're based on other, which is a whole nother video, but they're based on other concepts. And we do not lose flexibility in the management for you as a client. That's all for now. Just a quick message on the differences between different types of financial advisors. I hope you guys are doing well. I'm still here in sunny Florida. We're in a new location now, but we're getting ready to go home soon. I hope you guys are doing well. Talk to you soon. Bye.